Hi, my name is Laura Rose with Rose Street Advisors. I'm one of the relationship managers here, and today we are going to talk about flexible spending accounts and how you can use those to save you money. What are flexible spending accounts? Flexible spending accounts allow you to save money on qualified medical, dental, vision, and dependent care expenses by using tax-free dollars. At open enrollment each year, you can decide how much you would like to set aside pre-tax for these expenses. The amount will then be divided by the number of paychecks you receive in the year and deducted from those. It is important to note that you cannot make changes to your elections mid-year unless you have a qualifying event, for example, a marriage, divorce, have a baby, or adopt. So you want to make sure you are able to use all the money you set aside. Then, when you have a qualified expense, you can use these pre-tax dollars to either pay for or get reimbursed for your expense, so you will never pay taxes on this money. There are three types of flexible spending accounts. The first one is the health reimbursement account, which is to be used with a traditional medical plan, not a high deductible health plan. A limited purpose reimbursement account to be used with a high deductible plan, and then dependent care reimbursement. Let's talk a little bit more about how each one works. So first we'll talk about healthcare flexible spending account. Each year the IRS sets what the maximum amount you can set aside for qualified medical expenses. The amount you elect to set aside for the year is available for use at the start of the plan year. For example, if you elect to contribute $1,000 for the plan year, and then if you have an out-of-pocket medical expense for $1,000 1 month into the plan year, you can submit for reimbursement even though you have not contributed the full $1,000. You will pay back the account as the year continues through payroll deductions. So what is a qualified medical expense? The IRS defines it as eligible expenses to treat or prevent physical or mental defect or illness, including medical, prescription drugs, dental, vision, over-the-counter drugs, either with or without a prescription. See the IRS publication 502 for more information. You can also go online to the FSA store to see hundreds of over-the-counter items that are qualified expenses, such as menstrual products, thermometers, sunscreen, and much more. As I stated, it is important when deciding on your annual election that you'll be able to use all of the money you set aside because there is the use it or lose it rule. But typically plans have either a carryover rule that allows you to carry up to whatever the IRS allows to the next plan year, or a 2.5 month grace period that allows funds from the previous year to be spent in the following year. Ask your employer or your relationship manager if either applies. Next is the limited purpose FSA. The limited purpose FSA is to be used in conjunction with a high deductible health plan in which you typically will open a health savings account to set aside money for pre-tax qualified medical expenses. The limited purpose FSA is for dental and vision expenses only. Again, the IRS will determine each year the maximum amount that you can contribute, and again, you will need to know if your plan has the use it or lose it rule, or if they allow carryover or the grace period. Dependent care flexible spending accounts is used to pay for eligible child and adult daycare expenses for your dependents to allow you to work or go to school. The IRS sets the maximum amount that you can set aside each year, which has been set at $5,000 for several years. Unlike your healthcare FSA, the funds are not available for reimbursement until they are deducted from your pay. You can also choose the child care tax credit when filing your federal tax return instead of using dependent daycare FSA. Ask your tax advisor which would be best for you. So you decided to set money aside pre-tax in one of the flexible spending accounts. Now what? The accounts are administered by a third-party administrator. There are two ways to use the funds in your account. You can submit a receipt for reimbursement, or most TPAs offer a debit card that you can use for qualified medical expenses. When using the debit card or submitting for reimbursement, you'll need to keep the receipt, which needs to have the service date, provider name, patient name, what the expense was for, and the amount you paid. For medical expenses, the explanation of benefits that you receive from your medical carrier is the best document to submit because it has all of that information. The only time you will not be asked to submit a receipt for a medical expense is with set copay office visits or prescription drugs that you pay with a debit card. Thank you for your time, and if you have any questions, please contact your relationship manager or contact info@rosestreetadvisors.com or call and ask to talk to one of our benefit advisors. Thank you for your time, and if you have any questions, feel free to reach out to your relationship manager or feel free to email info@rosestreetadvisors.com. Thank you.